The stock market is having a wild ride right now, and I really thought it was time to share with you some insights about what you should be thinking, how you should be handling these big ups and downs. Well, right now, big downs on the stock market. Should you be panicking? Should you be selling? Should you be staying out of the market? Really, how should you be handling and interpreting this in terms of your big financial freedom goals? It is swelteringly hot right now. I'm standing in Saudi Arabia in Riyadh again, and I wanted to jump on and share with you this because I've seen so many of my clients in Financial Freedom University posting on the Well Chef page and elsewhere really getting very anxious about this time. And I thought, let me share with you how I started my day today. Yes, we've just had a massive big drop on just about every market around the world, and this time it's been triggered by some uncertainty happening in China. And this morning I woke up exceptionally excited, and with my husband next to me in bed, we got up to something really fun and juicy. Yeah, what we did, we whipped open our laptops and we went and had a massive shopping spree. Sorry if that doesn't sound so sexy, but for us it was really exciting because you see, when the stock market goes down, it is the most fantastic opportunity to stock up on a load of juicy, wonderful companies, because that's what it is about. That's what you're investing in through the stock market, that you can snap up at wonderfully reduced prices. When the stock market goes down, it's having a big sale. When you think about it, all around the world, people queue up at October Monday or whatever that's called, Black Monday, and in New Year's they queue up overnight outside of stores because there's going to be these big sales on, and they go running in, they grab every bit of money they can find, and they go and buy a whole lot of stuff, quite frankly stuff that they mostly don't need, don't want, and they get all excited about this. Now when the stock market goes down, that is exactly what's happening. But what do people do? They listen to the noise and the buzz going on the newspaper and the panic and, oh my God, is this a crisis? And they go, and maybe if they've got investments already, look and say, oh, I've lost money. And so they retreat. This happened in 2008 in big time when the stock market dropped down. People ran away, pulled their money out of the stock market. So what happens if you do that? Firstly, it's illogical. When you're in your growth stage of your investment, when you're building your asset pot, you actually celebrate when the stock market goes down, because with every bit of your regular investment, with every investment money you put in, you get more for your money. So then, as the stock market turns, which it always does, it always comes back up on that ride, you get greater growth because you bought it at a lower price. But so what people do is they look and see the value on paper has gone down, and they go, I've lost money. You haven't lost any money if the value's gone down. It is just an indicative paper value of if you were to sell at this particular moment in time, what you would get back from it. But remember, when you're growing your feast, you're not in a selling stage, you are in a buying stage, you're in a growth phase. So it's just a bit of academic information, quite frankly, not even that useful. You only lose if you sell. So that is the key thing. Your first step is breathe and know, actually, this is a great opportunity to buy, and it's definitely not the time to sell. You just want to hold and ride that circle. Secondly, you also know that one of the reasons why you set up an automatic investment plan, this is where you do regular investing in a set of index trackers, a single core investment tracker, or in a portfolio of index trackers. When you do this amount, you don't have to worry about what's going up and down in the market. And when you do happen to glance and see it on the news, you go, well, that's great, because you know your investment this specific month is just going to get you more for your money. And this is where you're using this thing called cost averaging, whether it's dollar cost averaging, pound cost averaging, euro cost averaging, rand cost averaging, whatever is your currency, the same principle applies. It just means that as the market goes up, you get fewer units of your specific fund, and when the market goes down, you get more. So over time, it all evens out and balances out in this wonderful upward trajectory. So that's the key thing. By setting up this regular investment, you get this cost averaging. So it all smooths out over time. The third key point I want to raise is one of the reasons why I really recommend to people that they only look at the value of their assets every 3 months when they look at their balance sheet and update their balance sheet is for exactly this reason. If you start staring at the ups and downs of the stock market, it can really give you the bejeebies. That's like being on a roller coaster with your eyes open the whole time, looking at every single turn and call. That's not what this is about. When you're an investor, you're about holding these assets to get them working for you in terms of both growth and income. That's in terms of dividends over time. The only people who should potentially be worried right now are those people who are traders. And there's a big difference between trading and investing. Investing is when you buy those underlying companies through the stock market and you have them sitting in your asset pot, bubbling away wonderfully for you, earning you growth and income. Within the future, you're going to start withdrawing income from that and start feeding off it. If you're a trader, on the other hand, you are actually wanting to make money by the buy and the sell component. Very, very different from investing. And that is when you get pretty nervous when the market's doing a lot of illogical, rampant things. So remember, this is just emotion, it's just reactive. The underlying intrinsic value of those core investments you have are absolutely still solid and there. And remember, one of the reasons why you invest in an index tracker is you also get a balance out, so you're not exposed to an individual company's volatility. You get a basket of shares. So maybe one company's price goes really radically, but as a whole, as the basket, you also dampen that volatility. And if any time is great to actually go and find all the bits of money you can, raid the kids' piggy bank if you need to, just joking there, but go and actually, this is a fantastic buying opportunity, and certainly will be for the next couple of weeks as we wait till the next upturn goes through to really be stocking up and celebrating the fact that unlike 90% of the people, you don't get sucked into the emotions and you understand what's going on better, and so that you can master and get it working hard for you. So I hope you go out and buy, celebrate this time, relax and breathe, and actually just sit back and know you don't have to look at this the whole time. And one last key point, if you might be saying, but Anna, I'm close to the point where I want to start feeding off my feast. I want to start, retiring, stopping working and earning my income so actively. What happens then if we have a big, what's called a correction, a downturn in the market, when I'm about to go into that? Well, that is absolutely fine too, because the reality is you don't want to be stifling the growth of your investment even when you're at the phase that you're eating off it. So what you're going to do, and you put a strategy together where you identify the money that you're going to need for the next 1 to 2 years in terms of by having a great spending plan together, and you allocate that money and you put that into what's called less volatile investments. That could be a money market fund. You could even hold it in cash, and you just have that's my monthly budget for the next year or so, and you leave the rest of your portfolio growing. This should be whether it's in your pension or your retirement funding. That could be in a self-invested personal pension, a superannuation, or 401k. This is far better. You don't want to be cashing those out or converting those into annuities. You want to keep them growing because they need to last and keep growing for you for a long period of time. And then you allocate that little bit of money so you don't again have to worry at all about what's going on in the market. In fact, it is a fun ride, but you can also completely ignore it whatsoever and just get on with living a rich, juicy life. So hopefully that's given you some perspective on what's going on in the market and why, when we really understand these things, we can give far more empowering meanings to it than following the herds who go into panic and actually then do lose money because they don't know what they're doing, and they get caught up into the emotions and all the hype that they hear all over the news and the newspaper. So maybe tomorrow morning you'll be having a juicy morning like I did this morning, having fun filling up that asset pot. If you're watching this video anywhere else than over at The Well Chef, please pop over there. I'd love to get your view, your insight on what's going on. How has this affected you emotionally? Has this been useful for you to just shift your mindset and understand how to really manage your own emotional state and your investing in these ups and downs? Please pop over to thewellchef.com and leave a comment there, because that is where all the fun and juicy, wealthy stuff is happening.